When you're trading options, Fidelity has just what you need with straightforward but powerful tools to help you select a strategy and execute your ideas. And they offer a wide range of information and insights to help simplify your trading experience. Have a question? Ask it live during their small classes and coaching sessions. Need information? Check out their educational videos, articles, and webinars. See why it's easy to trade options your way at Fidelity. Start now at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risks. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of Characteristics and Risks of Standardized Options. Supporting documentation for any claims, if applicable, will be furnished upon request. May 14th, 1 p.m. No, I don't want to talk about it. Market Call. Guy Adami, Dan Nathan, soon to be joined by the great Carter Worth. How are you?
You're such a weirdo. Okay, so this is a little...
Well, no, I am a
peeling back the onion a little bit. So we do Fast Money, 5 o'clock. It goes to 6 o'clock. Tim Seymour's on there with us. We're talking about the Ranger game. Pre-show, during the breaks of the show, we're in the green room taking off of our makeup. I say, Tim, I'm headed down there. I know he was headed down there. Let's share a car together. Let's walk together. And all of a sudden, Guy Adami's like, oh, I'm going too.
Yeah.
Didn't say a word the whole time. No. All three of us were there. We had Danny Moses there.
I know I didn't.
Well, I did.
Because when I go to the, I don't.
You're there to watch the game. Did you have a beer?
No, my wife and I shared a beer, one of those Stella big can, but we didn't finish it.
It was a fun atmosphere until.
Oh, it was electric
until the third.
It was electric, but they got outplayed.
All right, so we don't have to talk about it. Let's move on.
But here you go. Before we start, if you had said to me, Swizz, I know this is third person, before this series started, and I know people have said this, the Rangers will be up 3-2 going into Game 6. Would you sign up for them? Like F&A.
Yeah.
That's from The Deer Hunter.
Yeah.
Remember that scene?
Yeah. Well, I do remember.
Axel.
It's a pretty depressing movie.
It's really depressing movie.
Yeah.
I mean, it is, and it's 3 hours.
Dark. Your boy Fredo is in it.
Yeah, John Cazale. He was in 5 movies that were nominated for Best Picture.
Amazing.
In a period of like 3.5 or 4 years.
Way too soon. Hey, here's the thing. We're gonna do a hot 30 here.
Yeah, hot 30. I gotta pull up the rundown. Market, look at that. It's unbelievable, man. Market breadth too hot? ?
Yeah.
Which way will yields break? ? Walmart earnings preview statement. Industrial catch-up trade statement.
We're going to answer a few questions, and we're going to kind of talk about 2 ways that we're trading those last 2. So we're going to be definitive about that. We don't have the definitive answers to anything, but we're going to try to demystify a little bit of that. Guy, headed into the week, yesterday we talked a little bit. We still have earnings, some important earnings.
Stems and seeds.
We also have, you know where that comes from?
Marijuana.
Yeah. I'm surprised that you just
guys, when I was in high school,
guys and stems, we used to say.
We said stems and seeds.
Yeah. Not that we were users, and kids don't do drugs and stay in school. That's
just
a little
say no.
Just say no. That was a Nancy Reagan sort of thing.
Yeah.
But we got to get out of here in 30. So let's move it along. Let's talk about this market breadth. There's a smart reader or a smart follower, viewer, listener, Sam K. I'm not going to dox him here. He kind of hit me with some breadth information. And it's interesting because Amanda was working on it anyway, talking about how many names in the S&P 500 are above their 200-day moving average, right? And Sam's point when he showed me the data overnight was that basically this sort of price action, this sort of breadth causes investors to chase a little bit.
Yeah.
We're seeing a lot of chasing action in general, people reaching for, some of the meme stuff that we covered yesterday. Guy, when you see that sort of stat, S&P 500 versus the amount of stocks above their 200-day, it's showing that there is some pretty decent breadth in the market.
Yes, absolutely. So I look at yes. And it's a funny thing about numbers. You can make them look and seem and whatever you want them to do. So I would say, okay, that's great. And that's coinciding obviously with the S&P 500, which is the green, the blue being the percentage of stocks above, which is now almost 80%. All good things, right? But then you couple that with a VIX that has been under pressure, although yesterday seemingly got off the mat for the first time in a while. And I will say if everything is mean reverting, that actually to me signifies maybe the market's gotten ahead of itself. Now, people will say you're always looking for reasons to be negative, which is probably true. And I understand why you would look at this and say, you know what, all systems go. However, when you get that type of, I guess, relationship, that to me speaks of potential market exhaustion.
Well, especially at a time where you're seeing investors reach for some of this meme stuff,
well,
right?
that stuff.
No,
is,
but,
yeah,
but to me,
yes.
and I'll just say, when you have a stock like GameStop that was 5 billion in market cap a month ago, then 10 billion at the end of yesterday, and 20 billion today, that has to come from somewhere. When you look at all that options volume, we covered a bit of it last night on CNBC's Fast Money. So it might be one of the reasons why you have an S&P that's flat, a NASDAQ that's up a little bit. These retail investors are basically placing other bets. Let's bring in Carter Braxton.
Somebody's placing bets.
They are. Let's bring in Carter Braxton Worth to get his take on that comment. Hey, how are you, sir?
Good. I'm good. How's that? Yes. So we're
Thoughts
talking
on
about
Carter
the
a little
broad
bit?
participation. Well, the advanced decline line, whether you look at the events for the S&P or the New York Stock, it's making new all-time highs ever so slightly. So we know that the S&P, having dipped, is not back to the level from which it started to sell off about a month and a half ago, but the advanced decline line is making a new 52-week high, an all-time high. So that's one way to measure breadth, and there are many ways to measure it. But obviously, there's been broad participation. And yet some of the things that have been so good, the Qs are really lagging on a relative basis, and that's where all the money is. So there's been some catch-up trades. Banks continue to act better, regional banks, small banks, and so forth. Utilities have had a huge move. It's total catch-up trade, almost the point where, or not almost one, we've removed that as an overweight or as a buy. But the point is, there's been other areas of the market, there's perpetual rotation that's kept the overall indices sort of firm. But nothing lasts forever.
Yeah. So when you see almost 80% of stocks now, if you do the prior slide real quick, above their moving average, I mean, what does that suggest to you? I'm not pretending to know. I think things tend to be mean reverting, and at a certain point, something's got to give. But you encouraged by that, or is this more a signal of exhaustion, a word I used a few minutes ago?
It's an academic thing. There are studies that show, obviously, that you want to, generally speaking, if you think about it, of course, a moving average by definition is slow. So I call it the smoothing mechanism, right? Because it's many inputs. And so if current price is above a slower aggregation of its own price, by definition, you have more stocks and uptrends and downtrends and so forth. But there is no magic level or reading that says this is the time to sell or time to buy. It just reflects a state where most stocks are in uptrends.
Yeah. And again, maybe on Thursday, we'll take a look at the BKX versus the KRE. So the large cap banks versus the regionals when you're back with us, Carter, because I think the BKX is interesting. If you look at JP Morgan, it was, 200 at an all-time high right prior to its earnings, went down to 180. So that's about a 10% drop. 6.5% of that came on the day that it reported earnings. And now it's all the way back. BKX is back, at levels where it started to break down into that regional banking crisis. But the KRE is still well below, its 52-week and it's 2-3 year highs. Guy, this morning, Fed Chair Powell's out speaking. He's talking about, again, higher for longer. He said that will likely take longer than previously thought to attain the confidence needed to lower interest rates. Stock market doesn't care.
Shrug that off.
There was a time there that would have mattered. Now, tomorrow, does this statement make tomorrow's print that much more important? Does he have a little preview of the CPI print? Like, talk to me about how you're perceiving this.
I'd like to think the answer is no in terms of the preview, but I'm not privy to what goes on there. Number one. Number two, I mean, the PPI was hot. The revisions is what gave people, I guess, some confidence that maybe it wasn't as bad as expected. I think that's why the market sort of took their cues earlier with that rally that we saw on the back of it. But again, Powell reiterated it will likely take longer than previously thought. I don't know what they thought previously. I think they thought this would be fixed, a year or so ago. And here we are, multiple years into this. I mean, if you think about, again, it was November of 2021 when they indicated they were going to start to raise rates. We're now in May of 2024. So I think it's a lot longer than anybody except the biggest inflation hawks out there thought. And I still think it's problematic. But again, for whatever, and I laugh, I sort of chuckle, the market seemingly is looking past that. You're right to point out that language, a couple of weeks or so ago probably would have sent the market lower. Now the market just sort of shrugs the entire thing off.
Yeah, and Carter, a couple of weeks ago, the 10-year U.S. Treasury yield was at 4.75. It's at 4.45, even in the face of the potential of, let's say, a hotter number. And the commentary from Fed Chair Powell, we still have what feels like downward pressure on yields. You brought some charts. Walk us through it. You have been pretty firmly in the lower yield camp. And you've made a couple great points at really interesting inflection points, in my opinion, about yields. As soon as the narrative, I think you've said on many occasions, becomes somewhat uniform, you usually see it go the other way, at least as you've been talking about yields for the last few months.
Yeah, I mean, look, recency, we're all subject to it. I even think charting is about that. Wow, this one's strong, is breaking out. So let's go after, oh, this one's bad. Let's get away from it. That's what responding. Obviously, the idea is to predict those moves rather than respond to them. But good technique is also to respect moves and to go along with it. That's what respecting momentum is. And so to some extent, you see that all over the marketplace. But when it gets to be everyone in agreement, you usually want to sort of take the other side. So if you think about this chart with no lines, basically we were in August, September, and higher for longer became an expression, a bromide, an adage that became popular. And when things get popular, like AI or .com or anything, it's usually towards the end of it, right? And so was it higher for longer? We went above 5, exactly the opposite. Rates plunged, right, to 3.8. And down there, in December, January, they're going to cut 12 times with these low, hushed breaths, and there's going to be a recession. And then all of a sudden they abandon that, and then it's higher for longer again. This is the thing. The rates are doing nothing, right? And maybe it is just Goldilocks, and that you sit here at, call it 5 to 4%, and it's all good, and it's really 3% that's a problem, or 6% that's a problem. But the one thing that has to be said is that we're coming up on the 2-year anniversary of that spike in October of 2022, when we went to 4.35%. What's the reason that's important? Because that's the low for the S&P. That was the point at which the S&P was down 27% and the NASDAQ 100 was down 37. And so that spike in October of 2022, we're only 10 basis points above that. That was 4.35 and we're 4.45. It's 20 months ago. So rates are not higher. They are unchanged. But anyway, let's annotate it. So one way to put the lines in, you can flash that, put the motel sign on there. So, does it have to do what my arrow's implying? I think it is. It's a very precise little minor uptrend. Let's put a bigger uptrend in. And so we broke trend and we rallied back. And now any weakness here would put us right back to those highs of October 22, which would be that rates are unchanged for 20 months. I think that's what's coming.
Walk through your TLT. I mean, the TLT chart, I think, so you can look at it through the lens of the yields, but I think the TLT chart illustrates this thing maybe a little bit better in terms of, it gives you a different reference point.
Yeah. So we'll start with, because it'll be the inverse of this. Let's zero in on this moment. So this line is very precise. I didn't make it. I didn't fit it. I didn't talk to it, encourage it. It is what it is, right? Okay. Now let's put a second line in. That is what it is. So we go from essentially 3.8 to 4.8, up 100 basis points, 100 basis points in 5-6 months, and yet unchanged over almost 2 years. So the reciprocal, of course, instead of yield, is price. Let's go yield price. Let's do them both. First one, second one, first one. Okay, it is what it is, right? It should appeal to the eye. The lines are what my eye sees, but I try to put lines that then will help other people see who maybe haven't spent as much time looking at things as and then there's that. Okay, does all of that have to play out? No. Someone else say, that's the stupidest set of lines I've ever seen. This thing's going 85, yields are going to 550, higher for longer for sure, inflation, stagflation, it's all. Hey, that's what makes a market. What I see is what's depicted here.
Yeah, it's interesting. And again, we have the CPI tomorrow. TLT is generally a low vol in terms of, the options market sort of instrument here. And, I think we have a chart of the implied move, between now and Friday. And again, this is not something that we chart or quote too frequently, but because of that, CPI has the potential to really move yields, and it has in some instances over the last few months or so. We have about a 1.2% implied move between now and Friday's close. And so if you think that, for instance, let's say that CPI number is soft tomorrow, right, light or something like that, and you think yields will come in, okay, the way Carter does, and I know you're not making a call Carter like tomorrow or, this week or something like that. The at the money call or put on either way and the TLT is about 0.5%. You know what I mean? So that's what you'd be risking. Let's just say if you think that this thing's going to rally because yields are going to come in, you could buy the 91 call, and we have the ETF trading at 90.75, about 50 cents. It breaks even at 91.5. Okay. You could look out to June expiration. Okay. And you could pay $1.50. That's about 2%. Okay. Of the TLT, and play for that move that would be breaking out above that downtrend that's been in place. So again, we're not trading this right here. I'd rather wait for the data and see how it's perceived by the market guy. But it's interesting that the implied movement is not particularly great between now and June expiration.
No, what I will say is, again, if you had asked me without me knowing the answer to this in similar fashion, the JP Morgan implied move a couple weeks or so ago, when the implied move for that stock was 3.2% after earnings, given where that stock was, it didn't make sense to me. I will tell you, given where yields are, this doesn't make sense to me either. I'm very surprised there's only an implied move of a little over 1%. I would have thought it'd be significantly more than that. So again, I don't want to say the market's mispricing it, because the market prices what it prices. It's not mispriced. I just think there's an opportunity here to be long volatility into this number tomorrow morning is what I'm saying.
All right. And here's one, we spent a lot of time on some consumer names over the last few weeks, kind of parsing through some of the commentary about the, the U.S. consumer. So it was, the names. It was Starbucks, it was McDonald's, it was Nike, there was Disney, there was a few others in there. I think that Home Depot this morning was kind of interesting. Wasn't particularly great. The stock was trading down. It's, I think, about flat now as we look at it here, which again, the stock has really underperformed. It's down a little more than 1%. Yeah, 1% or so. Not a great looking chart. We don't have to spend too much time on that. But Walmart pre-opening Thursday is interesting to me. An implied move about 4%. We talked about it yesterday, on a relative basis to many other names in the retail space acting pretty well. This headline guy got me thinking this morning. When you have this sort of information leaked out, or however it came out a couple days before an earnings report, it always gets my kind of antennas up a little bit. What was your thoughts on that?
No, I mean, I don't know where I don't know where the information gets their information. I mean, I'm not trying to be cute here, but I mean, you're right to point that out. I mean, this is interesting in terms of some of the layoffs. It's not a huge amount of people, but it speaks to something. And I think what you're going to start to talk about is, potentially margins and what are they seeing and what's going on with their client, which doesn't theoretically augur particularly well for their earnings release.
All right, Carter, I have two charts here. My charts, not yours. Maybe you can grade my lines here a little bit. This consolidation that it's been in over the last couple months. It's interesting. It was kind of downtrending, but then as of yesterday, it looked like it wanted to kind of make a run for its prior all-time highs, maybe a little bit of a breakout. That would have been a little curious, a couple days in front of earnings, in my opinion. But here we are. It reversed yesterday's gains, and we're down about 1.5% today. You see that uptrend. Maybe it's not that important of an uptrend. I see that 200-day all the way down there near 56 or so. And then I have a 5-year chart. And I think this is kind of interesting too. If you look at that kind of, you see where the support is, right? A little bit. Are my lines okay? Am I looking at this correctly? Maybe that flag looks kind of bullish from a purely technical standpoint. I'm just curious your thoughts before I get into the trade.
Sure. Let's go back to the sort of here and now chart. The issue is, yes, one could say, is it a trend line? You can connect any 2 points, so arbitrate to that extent, but it's not really about that. And the lines help one come to a conclusion about what the price action is what it's saying. And what it is, independent of the lines, is that you have a sequence of a low at the same time as the market low. You have a powerful 2-3 month move. In this case, 50 to 60, so a 20% move, a period where the S&P went up 28. And then you have sideways, which is resting, consolidating. And so the consolidation is in response to the steep preceding move, and it's normative, if you will. That happens quite often. You advance aggressively, and then you check back, or you sideways consolidate, both of which constitute reaction to the preceding strength, consolidation or resting. And more often than not, right, you get resolved by then a directional move in the same direction as the preceding directional move. So strength, rest, strength. That's not always the case. Think of Meta. Meta had the same thing, and then it fell out of the formation, right, out of the consolidation, the downside. And so for me, it's a pair of twos, right? Like I think it's too much jump ball. It could just as easily print 57.50 and break down out of this consolidation range, as well as break out. And so I would just say what your view is or your bias, whatever you've come to, I'm all for it. But it is just what it is. Strong move, a big rest or consolidation, and this is what's important about patterns. The patterns that set up are always resolved by the fundamentals, but we can reverse engineer it. Whenever you get this kind of setup, a stock about to break out or down to the 150-day, you can almost invariably say there must be news coming, because they always get into these positions just before the news is released.
All right, here's what I'll say. I mean, I've been predisposed to be bullish of Walmart for a while, into earnings as well. I'm not going to run from that. However, when you saw those headlines from the information, then see the following chart, which is implied vol versus historical vol. This, to me, there's some warning bells here. And in terms of the warning bells, this is what I'll say. Implied vol is obviously spiking here, and you've seen that happen. You can look at the chart.
Mm-hmm.
There have been 4 other times over the last, year and a half or so. So that to me speaks of, maybe there are some alarm bells going off in silence. Is that a song?
Yeah. Well, I think what you're doing is quoting a lyric from Green Day. She screams in silence.
Right. Something
it's a great
like that.
song.
I love the Green Day.
No, so it's interesting, Guy. You have been positive predisposed from a fundamental standpoint, and the stock has acted in kind. You thought they would benefit from inflation. They have a lot of exposure to food and the like here. I guess what I'm kind of leaning into right now, Guy, is some of the stuff that we heard from some of these other consumer names. I don't know how Walmart avoids that. You look at this implied vol chart. So in blue, you get these moves into earnings, right?
Mm-hmm.
As investors get a little worried. The pink line is realized vol, how much the underlying has been worth. You see that the spread is pretty wide right here. This is actually only going to help inform the trade that I put on,
right,
because I want to sell something against the thing that I'm buying here. So again, I want to lean lower for the technicals, for the fundamentals, and for valuation. I just feel like it's a bit stretched, especially after we saw the reaction to Costco's results about a month and a half ago, guys. So here's the trade. I'm looking at Walmart. The stock is trading around 59.70 or so. I want to put a short dated put spread on that. We're buying a near the money put. Actually, in this case, it's an in the money put, and it's selling one of the out of monies. I want to target that 200-day moving average that is rising or so. And I also want to target a gap fill from that November earnings report, where they didn't have so many great things to say about the consumer back then, Guy. Everything that I read about the consumer, our friend Doug Cass has been sending us some really good charts over the last couple of days. It really feels like it's coming under strain. And it'll be
I agree with that, by the way.
What Walmart has to say. So today, when Walmart was trading around 59.67, you could buy the June 60.55 put spread, paying about $1.25 for that, buying one of the June 60 puts at $1.50, selling to open one of the June 55 puts at only 25 cents. But again, I think 55 would seem like a nice level to find some good support. 125 is a quarter of the width of this spread. I'm already in the money a little bit. I have gains of up to 375 between 58.75 and 55, with the max gain below that. I have loss up to 125 between 58.75 and 60, with a max loss of 125 on the upper end here. I have until June expiration. As I do with all long premium directional trades, I want to look to cut this trade if it is losing, okay, at like a 50% premium stop, and I'll look to take gains on half the position if it's a double here. So again, I like the risk reward here. I like the fact that this is slightly in the money, which is actually offsetting a bit of that implied volatility spike that we've seen. And we're in the game one way or another here. I think that the chances of a beat and raise and getting this stock to make new highs and break out, not particularly great, Guy.
Yeah, no, fair. Everything you just said is spot on. I mean, if you listen to some of the retailers, listen to what McDonald's said, Starbucks said, we can go across a swath of retail earnings in both high end and low end that would suggest, maybe Walmart's going to feel it as well. Remember the move we saw in Costco post earnings?
Yep.
That was pretty dramatic to the downside. Obviously, Home Depot not acting particularly well today. And I'm not comparing Walmart and Home Depot. My point is, they have enough sample size to suggest maybe this trade makes a little bit of sense.
Yeah, and again, defining my risk. It's not something I want to short into the print here, but I like the risk reward. All right, Carter, we just want to take 2 minutes on this. You did some really great work on the industrial sector and a name in particular, and you're juxtaposing one versus the other. What I like about this is that, Guy and I are not particularly bullish on the broad market here, but it's easy to find some interesting relationships like this where there's trading opportunities. Please talk to us about what you're seeing.
It speaks for itself. 2 colors, 2 lines, try to present things that are optically appealing. And the human condition is say, well, heck, that blue line's got to catch up with that green line, or that green line's got to come back towards the blue line. Other people would bet the opposite. That's a spread that's going to widen. But it is two very obviously straightforward instruments. One is an entire sector. That's the Spider XLI. So that's GE and Honeywell and Union Pacific Railroad and Caterpillar and on and on. And the other is one of the constituents in the green line, Honeywell. But that's pretty big divergence. And so my hunch, divergence alone doesn't set up a trade, but if the absolute pattern itself is starting to be interesting, then we've got something. So let's go to it. Here's the absolute pattern. And first iteration, if you put the lines in, I think we're going to push out up and out of this formation. Let's look at another and that, right? And so does it have to be head and shoulder? People want to see, again, you're like lying your back in the field. You can see anything you want in the clouds, but this is what my eye sees. And then the longer term pattern, to put it in context. So we have the COVID low at 100. The darn thing then rallies aggressively to 230. And it's been basically meandering, right, in a series of lower highs, higher lows, working into the apex of this formation. And at some point you get resolved. I think it gets resolved up. I'm a buyer.
Yeah, it's interesting, Carter. If you were to do, that's your static chart. But if you go just back to 2020, I think yours goes back maybe 10 years or so, you'll see that Honeywell, as your chart shows, made its all-time high, I think, in the summer of 2021. But since that point, you've had this sort of sideways consolidation action. You'll see it much better in a shorter term there you go. Now you can see it really well. The fact that for the last, few years, it's been sideways action. Again, the ranges get more narrow and more narrow suggests it's going to break one way or the other. And given what we've seen in some of these other industrials that are not nearly the company, by the way, that Honeywell is, the suggestion probably is that it will resolve itself to the upside, Dan.
All right, Carter Braxton Worth, we appreciate you being here with us. We'll see you on Thursday. Let's hit the bank.
Thank you. Bye, guys.
Appreciate it. Thank you so much.
Carter looks good, like a handsome man. By the way, Dan, trading options might be new for you, or maybe you've been doing it for a while. Either way, Fidelity is your go-to source for clear and relevant information about trading options. For example, ask Fidelity professionals questions during their live small classes and coaching sessions and learn more with educational videos, articles, and webinars. Plus, with Fidelity's straightforward tools and technology, you'll find it easier than ever to trade options your way. See what's waiting for you at fidelity.com/options. Option trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of Characteristics and Risks of Standardized Options. A lot of Ks, sorry. Supporting documentation for any claims, if applicable, will be furnished upon request.
That was kind of cruel and unusual punishment. That read. I'm just saying,
it was a lot of
stuff going on there.
But I do my best.
By the way, I've been an active Trader Pro user on the Fidelity platform for almost 20 years, and we use a lot of institutional tools also. You know what I mean, in our business life, and that is about as good as it gets as it relates to the sorts of tools I've used professionally. So I have been trading options for a while.
No, it is the platform.
And they have a lot of good resources there too. All right, really quickly before we get out of here, guys, let's clean up a couple trades here that we've talked about over the last few weeks or so. This was on May 7th. It was Tesla. It was a week ago. The stock was trading at about 180. I was looking to leg into July puts. What does that mean? I wanted to buy July puts for their Q2 delivery number, but I wanted to finance them by selling some shorter dated ones. So I looked at the May, July 170 put calendar. I was buying the July and I was selling the May. And the whole idea is that if the stock on Friday's close is above 170, the premium that I took in for selling that May, I would take, and it would help finance the purchase of the longer dated July. Well, right now the stock's about 176. The May is worth about 94 cents. The July is worth about $10. So that spread costs about $9 right now. I paid $8.25 for that last week. So I'm doing okay. If we get to Friday's close, the May will expire worthless.
Right.
Okay. And then I'll basically end up owning the July. At that point, I might do a calendar again in June, guy, depending upon where the stock is, or I may look to sell and create a vertical spread by selling a lower strike put. So that's how I'm trading the Tesla or managing that. I want to go to a trade on April 9th, guy. It was in Nike. I was bullish. I wanted to buy some June calls, but I also wanted to finance the purchase of those calls. The stock was 90.75 at that point. I looked at the May, June 95 call calendar. It cost me $1. I was selling the May 95 call and I was buying the June 95 call. That spread again cost me $1. Well, right now, the May 95 call is worth, I don't know, like 35 cents or something like that. We're below it. We're about 93.5. So we've gotten some appreciation on the stock. The June has gained in value here. And so ultimately the June 95 call is worth about $2. So again, I'm up, I don't know, 45 cents on this sort of thing. I want to look to do the same thing I did with that put calendar. If we get to Friday expiration and this thing is near worthless, I'm either going to cover the May call for pennies and I might look to sell a 100 call in June and then have the 95 100 call spread, guy.
Makes sense. I thought I thought you were spot on with the timing of it.
Yeah.
And I thought you had it cold. And the fact that it sort of made that little move to the upside and then it's sort of inside, it's somewhat perplexing to me, but I still think this trade is absolutely in play.
All right. Well, we'll refresh this one again, maybe next week. All right, guy, we got to get out of here. We covered a lot of ground. We have to thank Carter Braxton Worth. We have to thank Fidelity. We have to thank FactSet because they just hook us up with all the data here. It's pretty good.
Dan, if I want trade ideas, how do I get them?
You can get them to your inbox. You can go to riskreversal.com. Amanda and Jacob and Timmy, our whole team, they put the show notes in an email sent to your inbox. All you got to do is go sign up for it there. So go do that.
Do we have any social media accounts?
Oh, yeah. We actually have the Instagram. Guy, you're blowing up on it.
Well,
I don't know if you've checked that out.
Guy
Adami. I'm Dan S. Nathan. We have the @Risk Reversal Media Instagram account where we have a whole host of content there. Some clips from these shows, from Fast Money. It's a whole lot of fun. So go check that out.
Knicks play tonight.
Yeah, I'm going.
You're going?
Yeah.
Look at you.
I've had a lot of
You
back-to-back
are the
Knicks
MSG
and Rangers. I keep getting offered tickets. You know,
Gotta go.
I guess I'm a likable guy. That's not the
No,
case.
100%.
Yeah.
That
was very sarcastic.
The Mets lost last night,
which
epic.
made you very happy.
You know, it was a shitty night.
Yeah.
I mean, yeah, I shouldn't say it. I mean,
John Franco was sitting right near.
I don't.
Oh,
Really care.
really?
I mean,
really? He's one of your people.
What does that mean?
He's got a lot of vowels in his last name.
He's got an A and an O.
Yeah, well, it's a lot for as many as he has in his name. It's a good percentage.
He played for the Mets.
Oh,
so I'm just saying.
Well, he's Italian. That's all I was saying.
He is Italian.
Very unlikely pitcher, I would say, in the major league.
Yeah.
But that was 20 years ago.
Yeah. Mets lost last night. Their
you
closer
happy.
got
Makes you
smoked.
happy.
Makes
I
me
know.
extraordinarily happy.
I know.
Thank you for joining us. We'll be back to. Actually, I'm not here tomorrow. You and EY from SoFi.
And we're gonna go.
I'm
deep.
jackassing to Washington
Yeah,
D.C.
we're gonna take care of some business.
With who?
Well, your daughter. You're gonna go see.
Oh, you know,
Lil.
I got to pick her up.
Yeah, she's the
EY
mom.
from SoFi tomorrow.
It'll be Liz and myself. Check us out.
Yes, it'll be Liz and yourself.
All right.
See you later.
See ya.
Options trading entails significant risk and is not appropriate for all investors.